Welcome to the Investment Landscape module of the Instant Startup, another proud initiative of Innovis at Stellenbosch University. Now, as we start looking at the investment landscape, first we're going to just get a quick overview of this landscape. Why do you need money? Where does it come from? And a few tips to do as you get started. So first, what is capital raising? Where does the money come from? Well, there's three different sources generally. One is cash flows from operations. That's revenue and sales, where you build your product or develop your service and you sell it to your customer. Investing in interest or dividends from investment. That's if you put 100,000 Rand into the bank and you get interest from that sitting in your money market account. And then capital raising, which is what we're going to talk about now. So that's the third source, and it's also the least sustainable source of cash flow. Normally, if you need to get a large chunk of money at one time, that's when you would go out and raise capital. Then why would you raise capital if it is an unsustainable source? Well, you need to accelerate growth. There's an opportunity that you need to move quickly to take advantage of, and you might need to raise a large sum of money to do that. You might need to take on a large new project where a customer has come and said, please, can you do this for us? You don't have the resources to do it now, so you might need to raise capital to be able to take on that large new opportunity. If you need to create a new product, you've got a product in the market, it's doing well, it's generating cash flows, there's another opportunity that you want to move quickly to take advantage of, you might need to raise capital to create that product. If you need to enter a new market or country, if you're in the health space and you need to diversify into agriculture, you might need to raise capital to be able to enter into that. Or if you're based in South Africa and you want to open up a new market in Europe and you set up an office in the Netherlands, that's an expensive undertaking to get a whole new office set up and the legal processes to get an entity put in another country, you'll need to raise some capital for that. If you need to make a significant capital expenditure, hiring or buying a new building or buying new equipment or some new substance, if you're in biotech, you might need to have a large capital expenditure to be able to create a new product or set up a larger production facility. And you do this when cash reserves are not available or they're allocated elsewhere. So ideally, you're able to make these large investments from the cash that you've been able to make from operations, but if you don't have enough right now, or you'd rather hold on to it for an emergency with the current business, you would raise capital to be able to do that. And just one note that's very important, do not raise capital just to cover day-to-day costs. If the business is operating and it's selling things, try to grow incrementally as you can and cover your current staff. This is really just for new opportunities when you need to raise capital. So the types of capital that you can raise. The first type is grant capital. Now, where does grant capital come from? It comes from local and national government bodies, oftentimes the Department of Trade and Industry or the Department of Science and Technology. They'll have certain calls where they're looking to fund specific initiatives in a certain thing like energy or agriculture and food. Nonprofit foundations like USAID or the Rockefeller Foundation or the Gates Foundation and MasterCard Foundation, they're quite active in South Africa. Philanthropists, rich individuals that have done well in their business and entrepreneurial ventures and they are looking to give back. International funding bodies, DFIs as they're also called, like USAID and other kinds of international bodies that may or may not be attached to governments. Competitions. If there is a pitch competition for your specific industry or they're looking for certain regions, the SADC region in South Africa, oftentimes there's large international companies like Amazon Web Services that will have a Southern Africa pitch competition for a software thing, and usually the prize money there can be quite lucrative. Now, what are the pros of grant capital? One, it's free money. You don't pay any interest, you don't give away any of the company, it's just money for doing the impact that you're doing. There's lots available in developing economies. There's often a lot of competitions to pitch to or calls that have gone out from various sources that we're looking to fund initiatives in certain areas, and there's lots of those calls that go out. What are the cons of grant capital? One is not strategic in nature. They are really just looking to write a check and work with you, but there's not much input beyond that. They're not on your board. They rarely make other introductions into opportunities to get cash flow from operations to gain customers. Reporting is usually onerous, so it's a lot of time taken to make sure that the environmental, social, and governance, the ESG boxes are ticked for that money because they need to show impact for what they're doing. It's paid in tranches often, so you'll get a little bit here, a little bit there, 2, 3, sometimes 4 different chunks of payments come through, so you don't get it all at once. And the terms can change, especially with some of the emerging economy government grants, where in this quarter the terms are this, the next quarter I generate a report with the same terms, and the terms have actually changed in the middle of that quarter, and I didn't know. So that happens quite often. So that can be frustrating when you're doing the report. You think it's finished, but it's not. The second source, debt capital, and that's in the form of loans often. And where do loans come from? A bank overdraft, you have a check account. Often there's an overdraft that you can access in addition to just your normal check account. Bank loans, these are not overdraft, but you can get a specific fund, like a house loan if you're a person. You can get another loan specifically for a certain need that you have. Debt financing institutions, so not a bank, but there are funds like venture capital and private equity, similar types of funds that are set up, but they only give debt vehicles, they don't buy equity in companies. Shareholders. Your current shareholders or even senior management in the business can forego salary or loan more money into the company from their reserves personally, and then loan that to the company and set up a loan account for that. That can also be converted to equity at a later time, which we'll get into. What are the pros of loans? Well, the terms are clear. You get the money, you need to pay it back over a fixed amount of time, and you don't need to do anything else except for pay the money back. There's no or very light reporting. You really just need to pay back the money, and you don't have to generate documents on what you did with it every quarter. There's a shorter lead time. Where grant capital, the competitions can take a long time. The requests for proposals can also be several months long. Where getting debt financing, you can usually get that within a month or two. You don't sell any of the company, you don't give up any equity, and you usually get it in a lump sum once off. What are the cons? It's often not strategic, but it can be if you're looking to do something in the financial world, or if a bank has a large footprint in the agricultural sector, for example, and you're an agricultural company, you could get a loan from them, and they have other interests elsewhere, so they can make introductions for you, but oftentimes debt capital is not strategic. And it's also expensive, so the interest rates on these are even higher than a house or a car because there's no asset attached to it that is going to have a fixed amount of value at the end of the term. So oftentimes you'll get 15 and 20% interest rates on these loan sources. Now the third source is equity, and we're going to spend most of the rest of the module talking about equity financing. So where does equity come from? Friends, family, and fools is the affectionate word for any random people that you might meet. And oftentimes someone will have an uncle or a cousin that's done well professionally, or there's a little bit of family money that's put together. This is usually the first source, and it's usually the smallest amount of money. Angel investors are usually high net worth individuals that have been successful in life, and they have a bit more money to put into something. Your family and friends and fools might also be angel investors. Most of us don't know those high net worths, so they are professional investors that invest their own money on their own terms. Also, venture capital and private equity funds. That's another source where it's proper funds that are set up. They accumulate large amounts of capital, and then they make specific deals with specific companies, and they'll buy equity in those companies. They're usually exit driven, so when I give you R1,000,000 today, I want 10 million Rand for that R1,000,000 in 5 years. So there's quite significant terms on that and desires for how that money grows, so it's often not for everyone. There's also investor clubs that consist of angels and venture capital professionals, fund managers, and that where for example, the South African Business Angel Network, SABAN, SABAN, is a club of these kinds of professional investors that are looking for opportunities to buy equity in companies. Also, current shareholders of the business. You can forego salary, have that be a loan, and then convert that loan to equity at a later date, or you can invest more money from yourself into the business and buy more shares in the company. And the same for senior management. What are the pros of equity funding? It's usually strategic. They don't just give you money, they give you great knowledge and network in addition to the funding. And they can make introductions for you in other places. Oftentimes they pay you to do work for the company because they're looking for those large exits later down the line. The incentive for them is to grow your business, and they actively work at this. Where grant funding and loan funding, they won't try to grow the business. Equity funding, they have a share of the business and they're trying to grow their piece of the pie. Now, what are the cons of equity? It is the most expensive. That example, if my company is worth 10 million today and I raise a million rand revenue or a million rand investment, I give away 10% of the company. I grow it to 100 million rand value in 5 years. Well, then that investor exits that. So for his million rand, they now have 10 million rand. So that's quite a high interest rate, but I might not have achieved that amount of growth and that high value without having that investor working for me. You also give up share of the business, as we've spoken about, and also some control. So there's often a board seat that they require, sometimes two, or at least a board advisor role or a board observer role where they're able to see what's happening in the governance of the company. And they can oftentimes also only make certain decisions, or certain decisions have to pass by them before they can be done. Now, some tips for raising capital as you get started. Don't wait until you need money to start looking. If you need money today, it's already too late. Ideally, you start the process at least 9 months ahead of the current end of your runway. And runway is the amount of time you have given your current expenses and how much money you have, and the money you have divided by expenses, that's the amount of runway that you have. And ideally, you start the process at least 9 months ahead of that. Not everyone is able to do that, but that's the ideal. Diversify, have more than one source. Oftentimes, you'll see companies get debt and equity financing and a little bit of grant that's put in there to offset some of that. So you don't have to have one source. Even if it's several equity sources or several debt sources, have options. Look into different types of funding if you can, which is what we just went through. Don't lead with an NDA, a non-disclosure agreement. Have an initial conversation before you share things that you need to protect yourself from. Don't share secrets in the first conversation, and also don't lead with an NDA. Have that come after the first one to set up the second conversation. Trust and relationships are more important than money. So be confident, yet teachable and humble as you start these conversations. Understand that you're an expert in one thing. You might not be an expert in everything. Most of us going through these courses are really clever researchers, and we've done a lot with grant capital, but equity capital and debt capital, that's just a different animal. So it's a different process. It's a different thing altogether. So be confident in what you've been able to accomplish, but also understand that this is a different process usually from what you might know. And even if you've done this before, it is a new journey. So be teachable and humble as you start these conversations. What do you need to get started? You need some traction. You need someone using what you've built, even if they're not paying for it, but you need some data from users or customers or people that are using it out there in the world. You need a data room. It's documentation and all of the items and templates that have been discussed in this instant startup course up to now. Remember the folder structure that we're going to look at in the operations and governance model. So there is a folder structure that we recommend, and that is the data room structure that we recommend as you get started. You'll need a business plan. And what we've done in this instant startup course, you'll have most of what you need to be able to build a proper and complete business plan. And sometimes this can act as the agreement through which you raise the money. If you're raising equity capital in particular, you've put together a business plan. You might have put that together with input from the potential investor. And oftentimes, not every time, but that can become the plan that the investor is funding. So that is the agreement, and you have to stick to that plan. You also need a 1 to 2 page company overview. So all of the stuff that we've been through here, distilling that down into 1 to 2 pages that are the most important things, which we'll also cover later in this module of what goes into that, and a pitch deck, which we'll cover in this module. So there, oftentimes you can have several different types of pitch decks for different audiences, but we'll cover a basic template now that you then need to tweak depending on the investor, depending on the source, depending on how long the meeting time is, but you do need a pitch deck. Now, next, we'll look at understanding the investor. Understanding the investor in the investment landscape. Who are the investors? Well, we've covered the 3 F's, the friends, fools, and families. Normally, they're looking at a ticket size, in our context, somewhere around 200,000 to 1 million. Less than that, you can usually scrounge around and find. But that's roughly, these aren't hard and fast rules, but that's roughly the ticket size they're looking for. Their source of capital, inheritance sometimes, professional success of their own, or savings. Angel investors, they're looking at normally 1 to 5 million rand when they invest money. And their source of capital is significant professional success in previous investments that they have made. Venture capital, or the VC, they're looking at a ticket size of 5 to 20 million, and that's not also hard and fast, but that's roughly when you're needing that amount of capital, you go to a VC. And their source of capital is sometimes a collection of wealthy individuals. You have the 12J funds that now are not raising more money, but they're still deploying money in South Africa. And a lot of times those are high net worth individuals that have put money into those funds. Also enterprise development money, DFIs, previous fund exits, other family offices, sometimes corporate money can also go into those. And typically VC and private equity funds are fixed entities, not like a check account. They'll receive investments into a fund until that fund is closed, and they'll accumulate capital, sometimes 200, 300, 500 million rand, and that is set as that amount. Then they invest that money until they're out of money to invest in new things. They'll keep a little bit just to cover operations and legal costs for other transactions with their portfolio, and then after a fixed amount of time, they sell all of the stakes in those businesses, and that the original fund size has become larger, and that's how these things make their money. Private equity, a little bit later, they look at a ticket size usually quite a bit bigger in our context, 50 to 100 million. And again, these are not hard and fast rules. Sometimes you'll get VC investing that amount. And also these are numbers for the South African market. You'll see overseas that a VC is normally investing this amount of money and not a private equity firm. The source of capital, it's institutional funding, corporate balance sheet, DFIs. So oftentimes you'll get a bank like a Standard Bank or a Nedbank investing from their own balance sheet into this kind of investment. Corporate venturing, oftentimes you'll have a corporate set up its own venture fund off of its balance sheet and also get other funding from other sources. And they're looking at ticket sizes that's a lot broader in range, sometimes 10 to 100 million. So there's a massive range there. Their source of capital is revenues, balance sheet, enterprise development. It's legislated that they have to spend money on entrepreneurial ventures, and that's where corporate venturing gets its money from. Now, just an overview of how the progression of funding rounds typically goes, and again, this is not hard and fast, but you can see there across the various stages of pre-seed, seed, Series A, what the sources are in those different stages, about the size of investment that you're looking for across those various stages, what mechanisms that they use to invest, and we'll unpack some of what these mean, how much traction you need, and typically, again, not a hard and fast rule, but typically the size of the team that's looking at raising money in that phase. So some terms to know while you're navigating the investor landscape. What is a shareholder? It's someone or something. It can be an entity, a trust, or another business that owns shares in the business, usually founders and anyone who has invested money. What is a director? The director is appointed by the shareholders to direct the business strategy and ensure good governance. And often the investors serve as directors and they put that into their agreements, as well as some founders, not always, but some. And often the CEO is a director by default, as noted in the MOI, the Memorandum of Incorporation. Other management may also be directors. Management, the senior executives in the business who the directors have delegated authority to run the day-to-day operations and implement strategy. In startups, oftentimes, the founders can hold all three of these roles: shareholder, director, and senior management. More terms to know. What is the CIPC, the Companies and Intellectual Properties Commission? They are the regulatory body that governs the activities of companies in South Africa as outlined in the Companies Act. Memorandum of Incorporation, or the MOI. It's the basic foundation of how the founders and shareholders desire to run the company. So it's almost the constitution of the business itself. And this is also submitted to the CIPC, and all above mentioned parties must be very familiar with this document, as that is a legally binding document. What is a shareholders agreement, SHA? It governs how shareholders relate to each other and only binds those who sign it. If you're a shareholder, sometimes you may not be a shareholder if you do not subscribe to that agreement. It's used with the MOI, usually in parallel, but it is not required to be submitted to CIPC. Terms to know regarding investments. Vesting. Rather than all shareholders getting all equity up front, sometimes a common practice is to have their shares vest over time. So if a founder is getting 10%, you can say, okay, this is going to vest over 2 years, and then every month a portion of that 10% vest over that time. Example, 9% of shares vest with shareholder 1 over 3 years. At the end of each month, for 36 months, shareholder 1 will receive 1/36th of their 9% shares, or 0.25% of a share each month. A cliff, used in conjunction with vesting. Instead of monthly vesting of shares, a cliff is set where all previous owed shares vest at one time. So another example, 9% of shares vest with shareholder 1 over 3 years with a 1-year cliff. Shareholder 1 has no shares until the end of year 1, so they're not allocated monthly. But at the end of the first year, the full allocation of year 1 shares, 3% vest. So between months 1 and 11, they own nothing. At the end of month 12, they get 3% and then the 0.25% for additional months after that, as an example. Accelerated vesting. An event may occur like the sale of the company that brings all shares to vest even if the time has not passed. So sometimes in agreements when the business is sold or something, this can be activated. So for an example, buyer 1 buys the company at the end of year 2. Shareholder 1 has 6% already vested. Now, oftentimes what happens is the additional 3% will immediately vest if there is a buyout, and shareholder 1 receives compensation for the full 9% of shares due, even if they have not earned them out over the full 3 years. Now, why this is important is look at different options for how to allocate shares at the beginning. Oftentimes, it's a good practice to make sure that not everyone who's going to get shares in the company gets them immediately, but they have to vest over time. So if 3 founders come in and start a business together, and the reality of one of the founders changes at the end of the first year, but you've already given away all of the equity that you've agreed to between the 3 founders, one founder leaves, the other 2 founders stay and they take on all the risk, and then they're building the other founder's equity shares, but that founder isn't pulling their weight, the one that left the business. So oftentimes this vesting and cliff and these kinds of terms come into play just to make sure that people who are taking the risk on building the business have their shares allocated to them at the appropriate rate. and it protects the business itself and any future investors from having dead weight in the shareholder. More terms, sale of shares. There's different ways that shares can be sold. A forced sale, a shareholder is forced to sell their shares. This often happens when a founder leaves the company, so you can put those in the MOIs and shareholders agreements. A come-along sale, a company has 5 equal shareholders, each owning 20%. Buyer 1 offers to buy the company, and all but one shareholder agrees. The shareholders agreement can state that if 75% or more of the shareholders agree to sell, then they all must sell. So if 4 of the 5 agree and 5 doesn't want to, they can be forced to sell their 20%. A tag-along. If a company offers to buy 60% of the shares of the company, the shareholders agreement can also state that if there is a purchase of half, 50% or more of the shares, and those variables can change, then the buyer must also offer to buy the shares from the other shareholders on the same terms. So you can't, this prohibits a large shareholding being held and a large chunk of the initial shareholders being bought out, but then not everyone is able to exit at the same time, and control of the company changes, and it can create a negative state for the founders that have stayed around, so it can force them to be able to exit their shares. And exit. It's when a shareholder sells their shares in a company and receives payment for the value of their shares at that time. A fund, a VC fund, is considered exited when a VC has exited all of the investments that the fund has made and is now sitting with all of the cash returns from that fund. So you exit individual investments and companies, and then the whole fund has been exited when all of those individual investments have been sold. Earnout. An example of this, shareholder 1 exits their shares, but they only receive 80% of the payment, for instance, immediately. They must work for the company for an additional year to earn the rest of their payment for the sale of those shares. So if I work for a company and I have shareholding in the company, we sell it to a large listed company, say a bank, I can sell it for R1,000,000. I receive 800,000 at the beginning of that when the transaction happens, but they can require me to stay around and work for a year to ensure a good handover and success of the company in the future, and then only pay out that last little bit at the end of a year. And then I might resign and go do something else. That's often what happens. But normally when there is an exit, not everyone gets the money immediately and walks away. There's often an earn-out to ensure a good quality handover for the future success of that business. Return on investment. What are investors looking for? They want to have a percentage of growth on an investment over time. So that's ROI, and that's what investors are measuring their own success for. So if an investor puts 10 million into your company, after 5 years they sell their investment for 30 million, that's a 200% ROI. That's how you calculate that. Internal rate of return. What is that? That's often a term thrown around in the financial world. It looks at the amount of growth of an investment on an annual basis that is realized only when an investment is exited. It is viewed as a percentage of growth over the life of the investment each year once the exit happens. So above we look at 200% over the full 5 years, but in that same scenario, the IRR is 32% over 5 years, and if it was 6 years, it'd be 25% if it took that extra time. And that gives you an ability to look at retirement annuities that you might have personally, or money market accounts where you're getting 3 and 5%, and that's small, obviously, compared to this IRR of 32%, and that is why people invest in higher risk companies like startups. Fees, so understanding how investors get their money. They make their money in 2 ways, through fees and through the carry, which we'll unpack next. The fees are a small annual percentage of the total amount of funds under management. So a typical fee on average is 2%. That means if an investor is managing 200 million Rand, that team, to cover all of their overheads and salaries of the investment team, their fee would be 4 million Rand. So oftentimes you need quite a sizable fund in order just to cover the costs of running an investment fund. What is a GP? A general partner, the partners of a fund that manage the day-to-day investment activities. An LP, these are terms often thrown around in a venture capital setting. Limited partners, those are the people that are partners in a fund that supply the capital to invest but are not involved in the day-to-day investment activities. The GP and LP can be an actual person, or it can be a business or a trust of sorts. Normally the LPs are businesses and entities and companies, and GPs are normally individuals. Who is on the investment committee? The committee that is appointed by the GPs and LPs to make the investment decisions of the fund. Oftentimes they also have incentives in the success of the fund, and the LPs will have representatives on that committee as well as the GPs. And there may be other third-party people that are appointed. What is the hurdle? The hurdle is the amount of growth that the LPs require before the GPs realize any of the profit when a fund is exited. This is often determined as an IRR number, which we unpacked before. And a common IRR required is 40% for VC funds. And all of this return goes to the LPs. So that 40%, it has to return that amount of IRR for the limited partners before the general partners get anything. And then over and above that hurdle is what is known as the carry. So once that hurdle has been reached, all further profit in the funds are split between the GPs and LPs, and that's really what the VCs are working for. And there's normally a percentage split of that. So often you'll hear 2 and 20 as the model. So once the 40% IRR of the fund is returned to the LPs, 20% of all profits above that go to the general partners or the venture fund management team, and then 80% of those additional profits go to the fund providers, the capital providers at the beginning. And as we noted, the typical carry amount is 20%, but it doesn't have to, oftentimes it can be larger than that depending on the context. What is evaluation? It's the process of determining the value of a company for investment purposes. And to go into that valuation, you have projections. And that's the projected inflow and outflow of money of a company based on the strategy, plans, and execution of those plans. So it's looking at the cash flows in and out, because the cash flows in the future make up a valuation, the projected cash flows. Net present value it's a method of taking into account those projections, and it's the value of the business in today's terms that sets the value of the business that investors are investing in today. So oftentimes the valuation will be set by projecting out up to 5 years, rolling that back to a value today, and then investing on the value of that today. There's several ways in creating that net present value, and there's not one commonly accepted right way, but every investor normally has their own way of assessing the valuation. Now that's getting an insight into investors, what they're looking for and who they are. And now, next we're going to get into navigating this investment process. In the investment landscape, we're going to look at navigating the process of getting investment for your stock. And first, we're going to look at how do you identify the right investor? Who should you start approaching first anyway? How do you identify that entity? You need to understand what stage your company is in. So we looked before at, is it pre-seed, is it seed, is it Series A? You need to understand what stage your company is in, and we provided that information previously. You need to know how much money you need, and what are those projections looking like. You need to make a strategy. You need to plan what it will take to execute your strategy and achieve the goals there, and then budget the expected revenue and expenses to achieve those goals. Adjust it to be more conservative. Things are never going to go according to the plan. It's almost always worse. Determine the amount of additional money needed to achieve your goals, assuming there's not enough revenue or cash flow from operations to achieve them, and you oftentimes need more than you think, and it's going to be harder to get than you originally imagined too. So make everything much more conservative. Adjust your projections down from what you think, because we're always overconfident. Then you normally need to raise more money than you think you're going to need. And now you figured out what stage you're in, you know what industry you're in, you know how much money you're going to need. You need to find a VC or a funder whose mandate includes your company. It makes no sense to go to a funding source where if you just did a little bit of research on their website, you would know that you actually fall outside of their mandate. And a mandate is a set of parameters or limitations on VC funds or other investors. Oftentimes, angel networks and corporate venturing will also have limitations. It's determined by the partners and enforced by the investment committee. And that determines where they are and where they are not permitted to invest. Oftentimes, more input is given to where they're not permitted to invest. They're usually very clear and upfront about those mandates, and they're usually easily found on their websites or by talking to various people that have dealt with them before. And if you're at a startup event, and there's a lot of events where investors talk about what does it take to get money from you, they're very upfront and clear about what they can and cannot invest in. Those mandates can include the amount of money that they're able to invest in a company, the stage of the company, the industry, where it's located geographically, the founder demographic, and any other variables that might be relevant to the requirements from the limited partners or just the desires of the fund itself. How do you meet the right investors? So now I know who I want to meet and what entity, but then now I need to actually go and meet them. Need to understand at the start that fundraising is a full-time job. In addition to the job that you have of running your company, it will take up a lot of your time. Make a list of investors whose mandate allows them to invest in you. So do your homework, look at various rosters. There's a lot of things like VC for Africa. The Western Cape government in South Africa has a lot of tools that anyone around the country can access, and you can make a list of the investors from lots of different sources. It usually takes a lot of work to meet an investor. Most investors in Africa rely on their network and positive referrals and using your social capital for more than 90% of their investments. So there's one very well-known venture capital fund in South Africa called Knife Capital, and they put out the stat that 93% of their investments come from referrals, from friends that send companies their way. Only 7% from a random form on the website or an email to info at. So this is the single biggest factor in early stage investing that investors highlight time and time again. It is the quality of the team, and the quality of your team shows that you can actually access these investors. How do you meet them? Don't wait until you're desperate for money to start meeting investors. Always keep a list of potentially relevant investors for your company. Get in touch with them. Put them on an emailing newsletter and keep them updated. Even a WhatsApp group. I've seen some founders do that where they just keep adding investors to a newsletter address, a newsletter list, or a WhatsApp group where they constantly push updates to them on their progress. Go to events, meet other founders. Investors often also attend those meetings looking for potential investments. They're looking for pipeline as much as you're looking for money. And there are certain times of year when there are a lot of events in a short amount of time. Usually early to mid-November, usually late September in South Africa, where there's a lot of these events happening in the startup space. And read articles about them. Look on VentureBurn and Disrupt Africa and other blogs and sources of information on investors and what they're investing in. You may know someone who could connect you to the right investors. It's a very small world, the startup space and investor space. So oftentimes we're a lot closer than we think. Now getting into the investment process. It is unpredictable to say the least. There is a typical progression that you should be aware of and expect, but if your experience does not follow this, you're with the norm. So there's not one way that this happens, and if it doesn't go exactly like this, you're not doing it wrong. It's just a different process because it is bespoke every time. You need to identify the right investor. So based on all that we've talked about before, identify the mandate of different investors, figure out who you want to meet, find the right investor, and figure out how to meet them. You get that introduction, you've secured that introduction with the investor or several investors. Then share with them a 1 or 2 pager, which we spoke about early on in this module, that you need to have a 1 or 2 pager available, and also a brief pitch deck to have available. You may need to also share that with the investor, but it just depends on what they're looking for. Oftentimes you can lead with a 1 or 2 pager, and if they ask for a pitch deck before a meeting, you can send one to them. And then have a pitch deck that is a little bit less than what you would go through in a meeting and explain with them in your first meeting, because your goal here is to get the first meeting when you send the 1 pager, or if they ask for a brief pitch deck. Then you get that first meeting. So you go through the deck, be able to have a conversation, you field questions on your pitch in the first meeting with your potential investors. So make sure that you've left some time to be able to answer some questions. Then the investor will do a basic analysis. So this is different every time. There's lots of meetings, back and forth, phone calls. They ask for information. They ask for more. They're trying to make sure that what you're claiming backs up and that the finances make sense. From here, the most common outcome is that you get a no. You'll hear more no's than yeses. Expect that and understand. So just be prepared for that, because you only need one yes that they want to invest or they want to take it further. Often you do want to try to get more than one term sheet, so you don't want only one, but it only takes one. There may be a partner meeting if that goes well, and again, not everything goes necessarily according to this progression, but this is typical. Depending on the investor, if you're working with an associate or an analyst, you may be asked to present your business to all the partners involved if it goes well. And then typically investments are made by consensus. So if there's 3 partners and one of them doesn't agree, they won't invest. So you need to seek to win over everyone. If you've made it this far, though, you're already set up to win. And then there's more communication. There's more emails, more meetings, more calls, several weeks before you receive a term sheet, and that's hopefully what you get. The term sheet, you get that, you receive it from the investors. They normally have a template and some standard terms in there. Sometimes they're negotiable, sometimes they're not. You'll receive more than one, ideally. It's like getting a quote for renovating your house or buying a washing machine. It's ideal to have more than one quote and more than one term sheet so that you know what your options are. And agreeing to this opens you up to due diligence if you do agree to a term sheet. You don't often sign more than one, but you ideally will have more than one to consider. And then due diligence. So everyone has a different format and a different approach, but generally it's the same information organized in different ways. So have all your documents ready in a data room that you share with the investor that they want to dig into more, and they'll ask more questions. They want to look at your legal agreements and everything. They look at all of your finances, all of the stuff that is confidential normally. And here the final terms are negotiated based on the findings of the due diligence process. And then the investment. The decision is made. There's lots of papers to sign, legal work to do, like a new shareholders agreement, often a new MOI that governs the company, other agreements that are identified as being necessary if there's gaps in some of your contracts. Have a lawyer that you trust that has experience in similar matters in this process. So don't try to do it on your own. It will be worth the money that you spend on a good lawyer to make sure that the company and the founders and shareholders currently are protected and their interests are represented. Your investor will also have theirs. Eventually more money will flow and you're off to grow your business. Now, in a simple timeline, what we've just explained, day 1, when you meet an investor, have these ready before you get started. Have the 1-pager, a 30-second pitch ready in a conversation, a 4-minute pitch deck, a 20-minute pitch deck. Have your investor wish list and have introductions secured to investors, and that's what you need to get started. Follow up with the investors in week 1 that you were introduced to land the first meetings. Don't let too much time go by before you get the ball rolling, because there's always lag. Ideally, in the first month, you want to have as many initial meetings with various investors as you can, either face-to-face or video call if travel is not possible, but try to get those done in the first month. Within 2 months, get the financial information ready for follow-up meetings with interested investors. They're not going to ask all of the financial stuff in the first conversation, so have that ready. In 3 months, you're going to have more meeting with additional fund leadership and other interested investors, so just more meetings, more conversations, more pitches. 4 months in, additional meetings with investors to solidify that relationship and interest. You should be receiving a term sheet somewhere around there, ideally, and then due diligence can start shortly after, so you're not even getting to that phase of things normally until you're 4 months into the process. In the fifth month, due diligence continues, and then it wraps up. There's likely some gaps and a few documents here and there and agreements, so just be ready to respond quickly. Have a lawyer in place before all of this happens. And in the 6th month, if due diligence goes well, the final terms of the investment are negotiated, the variables are completed, documents are signed, and then the money gets paid over. And that is the investment process. Now after that, that's the process up to there. Next, we're going to look at the pitch. So in those first meetings and those conversations, there's a lot of detail to make sure you put the best foot forward. So next, we're going to look at the pitch. Now the pitch is part of the investment landscape. This isn't everything, but it is the first impression that a potential investor has of you and your team and your business. So key information about your business you should always have ready and up to date for when an investor asks. Have a one-sentence pitch. What do? You need to have a very clear and concise one sentence. We help X do Y by doing Z. What makes you unique and different from competitors and alternatives? What are people currently doing to solve the problem that you're addressing, and why are those not working as well as yours? Have offhand average month-to-month revenue growth for the last 6 months if you do have revenue, average month-to-month customer growth for the last 6 months if you do have customers, or at least just traction of who's used it, what's happening, what is the use and data from that use and impact that you're having of using your product or service. Know what you're looking for in an investor and what you're not looking for in an investor. You need to have that ready. You need to know what kinds of investors you're looking for, have your wish list ready, and also some of the softer side of an investor, that some of those nuances of how do they negotiate, how do they treat different people in their team, how do they treat not the CEO in your team. Have some of those softer items also there on what you're looking for in an investor. Now, why is pitching important? Because it's not a document. There's a lot of information, a lot more information you can put in just a business plan or a document. So why is pitching important? It's an efficient way for customers and funders to get an overview of your business. So I can get quickly, what are you doing? Why should I care? What's the impact for me in buying your product or your service? It shows your communication abilities. Communication is usually a good indicator of the quality of leadership and sales ability that there is in the team. If you cannot communicate well, you're going to battle to land customers. So this is also a way that investors quickly can determine if you have what it takes to sell what you're building. The more you pitch, the better you become. It helps you clarify the value that your business is bringing and tweak it when appropriate. So it's not just pitching for investors. As you pitch in this practice, it also helps you consolidate your value proposition to your customer for those things also. How to pitch. Now, how do you go about it? Once you're in the meeting, you've got your stuff. How do you do it? You need to know the time that you have and stick within it. If you have an hour meeting with an investor, don't plan to pitch for 55 minutes. Plan to speak for half an hour and give half an hour for questions. Or plan to pitch for 20 minutes and have 40 minutes for questions. There's always going to be some pleasantries and introductions at the beginning for 5 or 10 minutes. So rather get your pitch down to 20 minutes if you have an hour meeting and leave more time for conversation, because that's where the investors start to ask the questions and get answers on the things that they're really wanting to do and know. And if you've done a good job in pitching, there's going to be a lot of questions. Practice. Be so comfortable with the info that it's like a conversation. There will be interruptions, and the audience is going to ask you questions. You want them to ask questions, so make sure it is personable, it is conversational, and when there's an interruption, embrace it and be prepared for that. Make it authentic and exhibit your culture. Don't say you're excited, be excited. Don't say that you're all about customer experience. Don't say that you're about empathy. Show empathy in the way that you pitch and engage with the audience that you're talking to there. So make sure it's authentic. Don't say things that you're not just because you know investors want to hear it. Have it exhibit your culture. If there's quirks and nuances about the way you do things and your branding, make sure that also comes through in your pitch deck. Take time to think about your audience and frame your pitch for them, depending on what angle they're coming from and what they're interested in. Scratch the itch that they have. Don't talk about things that are not relevant for them. Consider how your audience experiences and receives the information that you're presenting, not just how you can communicate it. So oftentimes you need to manage their attention and capacity to hear what you're saying. So you give them one bite of what you're doing. You give them a second bite, a third, a fourth, and a fifth, and you manage the consumption and digestion of the information that you're bringing them because you're very familiar with it. This is the first time they're hearing it, so they're not up to speed with you. So you need to make sure that you can manage their understanding of what you're doing through your communication. So give them bite-sized portions in a progressive manner to go through the information. And then get all of the important information out there. It does take more work to do this well because those can be contradicting thoughts. Make sure you manage how you present it, but then get it all out. But you need to make sure that it's all out in a way that it can land well and be heard and received. And as we have already said, leave plenty of room for further conversation and end with a clear call to action. So I've listened to you, now what? Do you need connections? Are you selling me something? Are you looking for investment? Have it very clear with what you're looking for. And say if we need 5 million Rand, we need 5 million Rand. Oftentimes saying 5 million Rand for X% can make your value either too low or too high. So it's usually helpful just to say we need this amount of money to do what we're planning to do, and then leave the percentage of equity open-ended. Now, what goes into the pitch deck? So we've gone through how to pitch and all of that. Now, what do I actually present? And we've provided a template for you in this Instant Startup course. Now, first, you're going to have a title slide with a logo. Who are you? What is your company? What does it look like? Get some branding in there. What's the name of your company? And show your logo. An elevator pitch. Help the audience put you in a box. We help X do Y by doing Z. Have a very simple, clear, one-sentence description of what your business is, who you serve, and what your goal is in serving them. And then they can put you in that box and listen to the rest of the pitch, understanding why they're listening and what they're listening to. Then talk about the customer's problem. So show that you know who your customer is, show that you understand what their jobs are or what they're looking to accomplish, show that you understand the gains and pains that need addressing of your customers, and then discuss how the system is actually broken, whatever system that your customer is operating in. Then show how you solve it on slide number 4. What are the products and services that you're offering? What creates the gain? What relieves the pain? And map the value stream that you fit in the industry or the market that you're offering your product and service in. Demonstrate that. So what are you selling? Match the gains and pains to your gain creators and pain relievers, and then show where you fit in the rest of the system. How big is the market? So start local in your country or region on the continent, and realistically on what you can address in the next 5 years. Realistically, again, be conservative. And note, what is your customer acquisition cost? What is your customer lifetime value? What is your monthly growth? That's the CAC, the CLV, and that monthly growth number. So what does it cost you to get a customer? How long does that customer stay with you on average? And then what does your growth look like in that market? If there is no revenue, then just show users or interest or leads, whatever it is that shows traction. Ideally, it's revenue. If you don't have revenue, show some of that traction. What is your business model? So what is the mechanism to deliver value? What's the packaging around what your customers are paying for? And list a few possible alternative revenue streams. So are you selling a subscription? Are you selling a community? Are you selling an asset? If you're making a beverage, if you're making Coke, you're selling a 1 liter, you're selling a 500 ml, you're selling a can of 240 ml. You might be selling the syrups to restaurants to put in their machines. What is the packaging that you're selling in a few possible alternative revenue streams? What is the proprietary technology? So do you have intellectual property? If so, what? Is it patents? Is it copyrights? What do you have? What is your secret sauce? What makes you unique? And it might be certain partnerships or skills or experience or know-how that you have, or you've been working together for 10 years on the same product. What is your secret sauce? And then what exclusivity have you built up with partnerships and experience that create a bit of a protection and moat for you, competitive advantage? What is your marketing plan? So how are you going to get customers? What channels are you going to use to get them? What is the current traction with your customers? Looking at the money. How much do you need and what will you spend it on? What is your current financial situation? And again, the money stuff is optional, so don't include this in the quick email that you send to the investor for the introduction. But have it in a meeting after the first one where they're going to ask some of those questions if they are interested. Just have it ready in a pitch deck. But how much money do you need? What do you spend it on? That can be in the original pitch, but the financial situation, don't give details of debt and everything until later in the conversations when you're closer to money actually flowing. Who's on the team? What are their roles and experience and accomplishments? Who are the people? What have they done? Why should I believe that you can accomplish what you're telling me? And then finally, the call to action. So don't just tell them lots of information and then leave them with nothing to do. But what do you want? Do you want customers? Do you want introductions? Do you want funding, connections? What is it that you're asking me to give you as an investor? Now we've looked at the landscape, we've looked at the process to raise money, we've looked at the different details and terms of what goes into the process, the timeline, and also the pitch specifically. Now you're ready to go raise capital. Good luck.